They say the hardest thing in trading is not finding the right stock, it's finding the right discipline. Anyone can buy a stock, most do. But very few know when to add to a winning position, and even fewer have the patience to let that position turn into a fortune. The real art of pyramiding, of turning a small stake into something substantial, lies in mastering yourself before you ever try to master the market. When I first started, I didn't have much more than $500 and a keen eye for patterns. I used to watch prices the way a farmer watches the weather. Every movement meant something. And I learned quickly that money is made when you're right and hold on, not when you're right and take quick profits. Most traders sabotage their own success by being too eager to snatch small gains. They forget that the big money is in the big swing, not in the daily fluctuations. You can start with $1,000 and turn it into 100,000, but not by gambling. You do it by compounding your judgment, by adding to your position only when the market proves you right, never when it proves you wrong. That's the essence of pyramiding. You build your profits the way a mason lays bricks, one at a time, on a foundation that's already strong. The first rule is simple: never average down. A losing position is like a leaking boat. Adding more weight won't save it. When you pyramid, you only add to winners. You wait until the market confirms your direction, and then you press your advantage. That's how you turn momentum into money. Most traders lose because they do the opposite. They add to losers, hoping for a miracle. They're governed by hope instead of logic. Hope is a fine thing in life, but in the market, it's a death sentence. The market doesn't care about your hope. It only rewards discipline and punishes emotion. When I first began to pyramid my trades, I learned the hard way what patience truly meant. After making my first successful short sale, I added too quickly. I wanted to make a fortune overnight. The market punished that greed by reversing on me, wiping out both my profits and my confidence. It took years to learn that pyramiding is not about aggression, it's about timing. You must wait until your position is well in profit before you even think about adding. Let's say you buy a stock at $50 with your $1,000. The price rises to $55. Most traders get excited and sell, afraid of losing their profit. But a professional sees something else: confirmation. The market is validating your analysis. That's when you consider adding, not before. You don't add your full size again, you add smaller. Maybe you buy another half of your original position. The key is to protect your base while giving your trade room to grow. Each new layer of your pyramid must be supported by profit from the last. If the market turns against you, your stop loss should be at a level that ensures your overall capital is protected. This is how you let the market finance your growth. The best traders are not gamblers, they are builders. Every dollar of profit is a brick, and every new position should be built with the market's money, not your own. There's a rhythm to successful pyramiding. It requires you to listen to the market's tempo, not your own impulses. When a trend is strong, it will give you multiple opportunities to add safely. But once the market begins to hesitate, once it shows weakness in volume, price movement, or momentum, you stop adding. The same instinct that helps you enter should help you sense when the move is near exhaustion. Traders lose fortunes by refusing to recognize that moment. They pyramid into the top of the market, mistaking euphoria for strength. By the time they realize it's over, the market has already turned, and their profits evaporate faster than they were made. I've lived that mistake more than once. During one of my biggest campaigns, I pyramided aggressively in a bull market. Every move higher convinced me I was right. I was right until I wasn't. When the break finally came, it was swift and brutal. I had built my pyramid too tall, too fast. The same leverage that multiplied my profits now multiplied my losses. That's when I learned a lesson that stayed with me forever. The same principle that makes you rich can destroy you if you lose your discipline. The market doesn't forgive overconfidence. Pyramiding only works when it's guided by strict rules. Rule number 1, build only on profit. Never use new capital to add to a position. Rule number 2, each new addition must be smaller than the previous one. This ensures that your risk per addition decreases as your exposure grows. Rule number 3, your stops must always rise with your position. You protect your foundation before you build higher. Rule number 4. Stop adding when the market starts to move vertically or when public excitement becomes obvious. By the time the crowd notices the move, you should already be preparing your exit, not planning your next entry. These rules are not glamorous, but they are the backbone of fortune making in the markets. The hardest part is not learning them, it's obeying them when the heat is on. Human nature is your real opponent in trading, not the market. The market merely exposes your weaknesses. It shows you your impatience, your greed, your fear, and it punishes each of them without mercy. You must learn to operate without emotion, to see the tape and respond to what's real, not what you wish to be true. Most traders talk about risk management, but few actually practice it. Pyramiding is risk management in its purest form. You're leveraging your success, not your hope. You're scaling into proven opportunity, not chasing noise. Let's go back to that $1,000 example. Imagine you're trading with discipline. You start small, risking no more than 2% per trade. Your first position moves in your favor, and you add a smaller position as confirmation builds. The trend continues, and each addition is funded by profit, not fresh capital. Over time, your $1,000 base could grow to $10,000, $25,000, even $100,000, not because of luck, but because of compounding skill and judgment. You're no longer gambling. You're letting the market carry you upward, step by step. This is how great fortunes are made, not in one giant trade, but in a series of disciplined, calculated moves, each building on the strength of the last. But understand this pyramiding is not for the impatient. It takes time. You can't force the market to move faster than it wants to. A good trend develops like a tide. It rises, pauses, recedes, then rises again. You must learn to ride those waves with calm confidence. I've seen traders destroy themselves because they mistook motion for progress. They bought and sold too often, never letting their trades mature. They'd rather be active than profitable. That's the mark of a novice. The professional waits. He adds only when the time is right, and he never lets emotion dictate his next move. There were times I'd sit in my office watching the ticker for hours without making a single trade. Not because there were no opportunities, but because the right setup hadn't appeared. When the right one did, I struck with precision. That's the difference between gambling and trading. The truth is, pyramiding doesn't just multiply your money, it multiplies your psychology. It forces you to confront your impatience, your greed, your fear of giving back profits. It teaches you that making money is easy, keeping it is the hard part. Every trader will face the moment when they feel invincible. That's usually the moment right before the fall. Success breeds overconfidence, and overconfidence blinds you to risk. The wise trader never forgets that the market can humble anyone, and usually does. I remember one particular campaign in a leading industrial stock. It was a textbook example of perfect pyramiding until it wasn't. The stock rose steadily, and I added 3 times, each addition funded by profits. My stops were in place, my emotions under control. Then the news hit a sudden political event that sent shockwaves through the market. My paper profits vanished in hours. I exited with a fraction of what I had made. It was a painful reminder that even the best strategy cannot eliminate uncertainty. That's why your capital preservation must always come first. No trade, no matter how promising, is worth risking ruin. You can always find another opportunity. You can't recover from losing everything. So, if you're looking to turn $1,000 into $100,000, here's the truth. It's possible, but it demands a level of discipline most people will never possess. You must treat trading as a business, not a lottery. You must think in terms of probabilities, not guarantees. Every addition to your position must be justified by logic, not emotion. Every dollar risked must serve a purpose to protect or to grow. You must know exactly when to add, when to stop, and when to get out. And above all, you must learn to think independently. The market rewards those who can stand alone, who can see opportunity before the crowd does, and who can exit before the crowd realizes what's happening. There's no magic in pyramiding. It's just the consistent application of sound principles, adding to strength, cutting weakness, protecting capital, and letting profits compound. If you can master that, your $1,000 can indeed become $100,000, but not overnight, not through luck. Through patience, judgment, and discipline, the same qualities that build not just wealth but wisdom. In the end, the real reward of trading isn't the money, it's the mastery over your mind, your impulses, and your fears. When you learn to pyramid properly, you're not just building a position in the market, you're building character. And that, more than any profit, is what separates the ordinary trader from the great one.